Imagine two guys, same age, same job, same salary. They both decide at 25 that they want to be millionaires by the time they're 45. The first guy, let's call him Daniel, buys a rental property. He puts down $40,000, gets a mortgage, and starts collecting rent every month. He feels good. He can see the house. He can touch it. It feels real. The second guy, let's call him Marcus, takes that same $40,000 and puts it into index funds. No house, no tenant calls, no leaking pipes, just numbers on a screen going up and down every day. Fast forward 20 years. Who do you think became a millionaire first? If you said Daniel with the house, you're not alone. Most people would pick Daniel, and that instinct makes complete psychological sense. But here's the thing. The answer is not as simple as you think, and by the end of this video, you'll understand something about wealth building that most people never figure out. Because this isn't just a debate about which investment is better. It's about how our minds are designed to think about money, and how that wiring quietly shapes the financial decisions we make our entire lives. Here's the thing about real estate versus stocks. It's one of the most argued topics in personal finance, and both sides get passionate about it, almost religious even. Real estate people will say stocks are fake, a house is something real, you can see it, rent it out, and it'll never go to zero. Stock market people fire back, real estate is a headache. Tenants destroy your property, repairs drain your profits, and you can't sell half a bedroom when you need quick cash. And both groups are kind of right and kind of wrong. But here's the real problem. Most people are having the wrong debate. They're arguing about which investment is better in theory, when the actual answer depends on something much more personal, how you think, how you behave, and what kind of investor you're actually capable of being. There's a famous psychological concept called the illusion of understanding. It means we think we understand something way better than we actually do. Ask most people how a toilet works and they'll say, yeah, water comes in, water goes out. But ask them to explain it step by step, and they stumble. We do the exact same thing with investing. We say real estate is a great investment, or the stock market always goes up, without really digging into what those things mean for us in our specific situation. So let's break it down, properly, simply, and honestly. Let's start with real estate. When you buy a rental property, you're essentially using something called leverage. You put down maybe 20% of the total price. So on a $200,000 house, that's $40,000 out of your pocket. A bank covers the rest, and now you own an asset worth $200,000 with only $40,000 invested. That's powerful. If that house goes up in value to $250,000, you've made $50,000 on a $40,000 investment. That's more than doubling your money on paper, even though the house only went up 25%. Think of it like a lever in physics class. A small force in, big movement out. That's leverage. And on top of appreciation, you're collecting rent. Someone else is essentially helping you pay off your mortgage every month. And in many cases, after expenses, the mortgage, insurance, maintenance, property taxes, you might have $200, $300, maybe $500 left over every month as profit. Now let's talk about the not-so-glamorous side. Real estate is what investors call illiquid. That's a fancy word that just means you can't sell it quickly. If the stock market crashes and you panic, you can sell your shares in seconds. If the real estate market tanks and you need cash fast, you could be stuck for months or longer waiting for a buyer. Real estate also has what I call the 3 a.m. phone call problem. The boiler breaks in January, the tenant hasn't paid rent in 2 months, the roof needs replacing and it's going to cost $8,000. These are real things that happen to real landlords, and they eat into your returns and your sanity more than most people account for when they're daydreaming about passive income. Now let's flip to stocks. When you invest in an index fund, basically a basket of hundreds of companies at once, you're buying a small piece of the entire economy. Historically, the U.S. stock market has returned around 10% per year on average over long periods of time. That doesn't sound as exciting as doubling your money with leverage, I know, but here's where the magic happens. It's called compound interest, and it's genuinely one of the most powerful forces in personal finance. Let's go back to Marcus. He puts $40,000 into index funds at 25. He doesn't touch it. At 10% average annual return, after 20 years, that $40,000 becomes roughly $269,000. And if he kept adding even $500 a month, we're talking about well over $700,000 to $1 million depending on the market. No phone calls, no tenants, no burst pipes, no property tax bills. But, and here's the flip side, stocks require something psychologically brutal. You have to do nothing while watching your portfolio drop 30 or 40% during a market crash. And those crashes happen. 2008, 2020. They are terrifying, and most people can't handle it. They sell, they panic, they lock in their losses and then miss the recovery. Warren Buffett once said the stock market is a device for transferring money from the impatient to the patient, and that's exactly what happens, over and over again. Here's the insight that most people completely miss when they have this debate. The best investment isn't real estate or stocks. The best investment is the one you will actually stick with. Think about that. It sounds simple, but it's profound. There's a massive body of research in behavioral finance, that's the study of how psychology affects financial decisions, that shows the average investor dramatically underperforms the market, not because the market is rigged, but because people buy high and sell low, because they panic, because they get distracted and chase whatever worked last year. The returns of an investment and the returns the investor actually gets are often wildly different, because behavior gets in the way. Real estate has a psychological superpower that stocks don't. It takes advantage of something called the endowment effect, our tendency to value things more once we own them. When you own a house, you're emotionally invested. You don't sell it every time the market dips. You hold on. You stay the course, not because you're disciplined, but because selling is hard, slow, and expensive. That illiquidity we talked about, the thing that sounds like a weakness, actually forces good investing behavior. You can't panic sell a house at 2 a.m. Stocks, on the other hand, are brutally easy to sell. One click, done. And that convenience is their biggest strength and their biggest psychological trap. So here's the real question. Are you the kind of person who can watch your portfolio drop $50,000 in a month and not touch it? Or does that kind of thing make you lose sleep, refresh your brokerage app 40 times a day, and eventually hit sell just to make the pain stop? Be honest with yourself, because that answer matters more than any return percentage. There's another layer here too. Real estate forces you to save. Getting that $40,000 down payment requires real discipline. You can't just casually drift into it. And that forced savings habit has an incredible effect on your overall financial behavior. People who save aggressively to buy a house often become better investors in general because they've already trained themselves to delay gratification. Stocks don't force that discipline. You can start with $50. There's no big moment, no milestone. And for a lot of people, that makes it easy to never take it seriously. So what does all of this mean for you? First, stop thinking about this as a competition with one winner. Wealthy people rarely pick one lane and stay in it forever. They diversify. They use both. The question is, where do you start, given where you are right now? If you have high income, some savings, and you like the idea of being hands-on with an investment you can see and manage, real estate might be your path. Start with one property. Learn the game. Understand your local market. Don't try to flip 10 houses before you've finished your first one. If you're earlier in your career, don't have a large lump sum yet, or you know you don't have the time or temperament to be a landlord, start with index funds. Max out your retirement accounts first. Set up automatic contributions so you're buying every month without having to think about it. Make it boring. Make it automatic. And then leave it alone. The biggest financial mistake people make isn't picking the wrong investment. It's waiting. It's spending 3 years debating real estate versus stocks and investing in neither. Time is the most important ingredient in wealth building. Compound growth needs time to do its thing. Every year you wait is a year of compounding you'll never get back. There's a concept in psychology called analysis paralysis, where having too many options or overthinking a decision leads to making no decision at all. And in finance, that paralysis is incredibly expensive. Not deciding is itself a decision, and it's usually the worst one. Start somewhere. Start imperfect. Start now. So let's go back to Daniel and Marcus. Here's what actually happened in our story.
Daniel bought his rental property, dealt with a nightmare tenant in year 3, had to replace the HVAC in year 7, and by year 15 his property had appreciated and his mortgage was largely paid down by his renters. He had real, tangible equity. He had cash flow. He wasn't a millionaire yet, but he was building real wealth. Marcus set up automatic index fund contributions, panic sold during the 2008 crash, sat on the sidelines for 2 years, got back in, learned his lesson, and never sold after that. By year 20, his portfolio was well into the 7-figure range. Both of them became millionaires, just differently, just through different paths that matched their personalities. And that's the real lesson. Wealth isn't about finding the perfect investment. It's about finding the right investment for you, and then having the patience, the consistency, and the psychological resilience to stick with it through the boring years, the scary years, and the years where it feels like nothing is working.
Here's the truth. Both real estate and stocks have made more ordinary people wealthy than any other investment in history. The ones who failed weren't defeated by bad markets. They were defeated by their own behavior. The market doesn't care about your anxiety. The market doesn't care about your timeline. It just keeps doing what it does. The question is whether you'll still be in the game when it pays off. So, make a decision. Take the first step and then do something that almost no one in finance will tell you. Be patient enough to be boring.